Hi, welcome back. I'm Sarah Irons. I'm a commercial finance broker and I'm bringing you a video today all about bridging, or short-term finance as often referred to. We have noticed so many new inquiries this month for bridging. I'm a regulated broker, which is great. It means I can help and advise on regulated and unregulated bridging. If you don't know the difference, don't worry, I'm going to explain it all in this video. I'm going to keep it as brief as possible, just so you know the basics, what it can cover, how much it costs, what the lenders ask for, so that you don't miss out on any opportunities. So what is bridging? Bridging came about if a property transaction fell apart. For example, somebody lost their buyer, then they couldn't buy their own repurchase, or if they really needed to secure a new purchase but they didn't quite have the money yet but it was coming. In the past, it was bridging a gap. So, you would be able to pay, but at the moment there was a gap until you could pay. And this became a loan that was offered for a very short term at a very high price. It did have a purpose. It definitely does have a purpose now. But this high price and expensive way of borrowing really stuck, and it sort of became a myth and a bad thing to do, and I think nowadays that's carried on. And I think if you're new to bridging, and obviously some people aren't, and lots of people are using it at the moment to find opportunities and get some value in properties, which I'm going to tell you all about. I don't want you to miss out on that just for fear of a bridging loan. So there was so much of this bad noise about bridging that in more recent years they've actually changed the name to short-term lending. Which is what it is. It's lending money for a short time at a higher price than you would get it if you went for a normal mortgage over a set term, for example. So yes, it is more expensive than normal mortgages. Used in the right way, it doesn't have to be more expensive, which I can also show you, but it isn't as expensive as it used to be. You can borrow quite high loan to values, and that did reduce recently with the market turbulence, but currently it's working its way back there, which is amazing. So yeah, there's lots being used, there's lots of opportunities, there's lots of ways you can use it, and I just wanted to talk you through some of those. So short-term finance, or bridging loan, is short-term, normally 12 months, especially if it's regulated, to 24 months. They offer you the loan based on the loan to value of that property. There are some differences if you're doing a refurb loan, but we're just going to keep it simple for now. So for example, they would lend 75%, some lenders will, of the market value of that property. So let's just say you've got a property worth 100,000, just to keep it simple. They would lend you 75% loan to value. This becomes your gross loan. So 75,000 is 75% loan to value, 75,000 gross. What bridging do, which is different to normal lenders, is they will calculate your annual interest and they would deduct it from the loan at source. They will also charge you a fee, which is typically 2%. They will also deduct that fee at source. So they deduct it from the gross loan. I've used an interest rate here of 0.8 per month. That would equate to 9.6 per annum. If you're used to mortgages, they quote their rates per annum, bridging quotes per month. Now, this is an average rate at the moment, I would say. I have done a quote for somebody at 0.47. I've also had a quote for over 1%. So this is quite average in the market at the moment. And obviously, given the market turbulence recently, they've sort of been 0.9, 0.92, 0.94, floating around that marker, but they're slowly starting to come down. We're seeing 0.69s, and as I said, I did have a regulated bridge that was 0.47, so that's really good. So yeah, we're working our way back. Not all the lenders have got back to 75% loan to value since the market turbulence last month, but one or two of them now have. So I've taken 75 as it won't be long before we do get back there. A lot of unregulated bridges are there, and I've taken 0.8, so an average rate in the market at the moment. So if we look at 75% loan to value of this property at 100,000, and we use 0.8 per month as the calculation, that works out at 7,200 interest over 12 months. The fee would be 1,500, which is 2%. Typically that's what they all are. So we would be deducting 8,700 from this 75,000 gross loan. That means that you would end up with 66,300 net loan. That's the money you will actually get in your pocket. So you will have to find 33,700 for your deposit on this purchase. However, they've calculated this over 12 months. So they've assumed you're going to have it for 12 months. You might not. So if that happens, let's say you have this property for 6 months, what happens is on completion, they will refund the 6 months interest that you haven't used. So you only actually do pay for the interest over the term that you've had the loan, but they always assume you're going to have it for the full term. And then on completion at the end, it all gets rectified and your redemption statement would show 6 months less interest. So that's how it works. And obviously if it's a bigger project or a refurb, then you can have up to 24 months, but bear in mind that the gross loan remains the gross loan. Then instead of taking 12 months interest, they're going to take 24 months interest. That gives you some breathing space if your project might take a bit longer, but it will mean you'll have less net loan, and therefore a higher deposit to put in. So just bear in mind the difference with normal mortgages. If it says 75% loan to value, that's what it is. But if it says 75% loan to value for a bridge, that's the gross loan. Always remember they take the interest for whatever term you've chosen and the fee off of the loan at source, and you will be left with the net loan. So don't make a mistake and end up short on your deposit. That's how it works. The beauty, of course, is they've taken all their interest, so there's nothing to pay. So there's no monthly payment. So there's no strain on cash flow if it is a refurb or you're doing this as a business. So you don't have to find the money each month, which is perfect. It's already been taken. In effect, you found it up front if you've put in a bigger deposit. So it's all swings and roundabouts, but that's how a short-term finance stroke bridging loan works in really simple terms. So I hope you found that useful. So what are we seeing a bridging loan be used for? Okay, so this can be right down to a residential purchase where you're buying your new property and you're selling your current one. Then just before you're exchanging or purchasing your new one, your buyer pulls out for whatever reason. Obviously that can be devastating. It has a knock-on effect on everybody. It might mean you can't now carry on and purchase your property, and obviously this causes a lot of emotion and upset. So a regulated bridge is a bridge on your home or a property you intend to live in. So anything you're living in is regulated, and the reason for that is it's your home. The underwriting is stricter, it's assessed heavier. Sometimes they will look at income, not necessarily for the bridge, because bridging you don't pay per month, so they're not very interested in your income, but what they are interested in is how you're going to get out of this bridge. So if it's regulated, 9 times out of 10 it's a property you're going to end up living in. So they want to know, how are you going to pay my bridge back? Therefore they might ask about the income, so they want to make sure your exit mortgage, whether that's one of the high street banks or whoever it is you might go to, will actually give you a mortgage that covers the gross loan. So everything that you owe the lender, not the net loan, the gross loan is what you owe them. So bear that in mind as well. So yeah, regulated is a property we're going to live in. So if we're looking at regulated, the smallest thing that we would normally see apart from a tiny auction purchase would be that scenario where somebody's lost a buyer and they really want to purchase this new one. So what they would do is they would get a bridging loan, which would probably be across the 2 properties. So a certain loan to value on the new one, a certain loan to value on the old one. If they don't have a mortgage on that old one, it would be a first charge. If they do, then we can do a second charge, which sits on top of their current mortgage. That can take more time because sometimes the first charge lender will have to give permission for them to sit on top as a second charge, which can slow down the transaction, but there are ways around that. So the other thing is, if it is a second charge, the loan to value is normally capped at 65% loan to value gross of that property. So bear in mind you'll end up with a little bit less than that. So it's a calculation across both properties to make sure you can get enough to purchase your new one. But most of the time it does work out. So that would be the smallest bridge regulated transaction that I would normally see. And they're quite common. Then we move on to different reasons for bridging, which can be buying at auction, buying a refurb, doing it up, just a little tart up and flip, or a bigger refurb with an extension, loft conversion maybe, and a flip, or you might want to then transfer it to a buy-to-let. Some developers that are using Bridging a lot and very comfortable with it will be doing big conversions with it. So they'll be purchasing properties, maybe changing commercial to residential. They might be buying what we call an acquisition bridge, which is either purchasing the land or purchasing a property, then sitting on it, going for planning, waiting for the planning. When the planning comes in, we swap it to another type of bridge called development finance, which I'm not going to talk about today. But yeah, acquisition bridge, so buying something without planning and getting planning, or with planning and tweaking the planning to make the site more valuable. You can either then sell that plot with planning, which will have uplifted the value, so it's sort of called planning gain. So that might be your strategy. Find a site, get planning, sell. Whatever works for you. Everyone's got a different strategy, but bridging plays a big part in people getting to their property goals, and you can make some good money and not miss opportunities. And because bridging is notoriously fast, it definitely did get slower. Like anything, it got more competitive, the rate started to drop, more people were doing it, therefore there were more applications, the lenders got slower, the solicitors got busy. But now the rates have sort of crept up with the market turbulence. We have noticed, well, at least one, maybe even two lenders that are turning bridging around in 10 days, which is, you know, you're sort of happy to pay more when you know you're going to get the speed, because bridging really is about speed. You want to act fast, you want to be the one that gets the offer accepted, and it might be lower than everyone else, but you've got speed. Sometimes speed counts for more than the property purchase offer that you've made. So we see it used so much for so many different things. And the list is endless, it really is, but they're probably some of the main things that we see it for. So just to move on, exit. So as a broker, especially as a regulated broker, we will look at things. We're trained to have a regulated eye, so we're very careful with what we do. We always will not put anybody into a bridge without having a viable exit. That means, how are you going to exit this bridge? How are you going to pay them back? Now, if you're buying a property from auction, doing that up and selling it for a profit, sale is exit. Really easy, really simple. You're going to uplift the value. As long as you've done your initial calculations, obviously the valuer goes out, checks the value is correct, check the property is sound. So the lender's pretty much covered. You're going to borrow the money, add value, sell it, they're going to get their money back. Their only concern then is, can you do it within the relevant timescale of the term that you set? How big is the project? Does it need planning? So there's some extra things that come in the bigger you get, but normally that is really simple. Sale is the exit. If you're planning to live in the property, or if you're planning to turn it into a buy-to-let or change commercial to resi and have this multi-unit freehold block of, say, 10 apartments or 10 flats in one block, for example, then we need to be making sure that we can get you a term mortgage, a normal mortgage, whether it's buy-to-let or reversion specialist lending like HMO, multi-unit freehold block buy-to-let, that you can get out of this bridge and pay it back. So we would want to know the rent that you're going to achieve, and we would make sure that we'd factored it in, so we also had a loan at the back end when your property was done and ready that you could switch on to. And actually now the lenders, the underwriters want to see that exit, so it's not just verbal, oh yeah, he can get out of it. Oh no, we have to prove that you can get out of it. And for a broker, I want to know that you can get out of it. And some lenders want 2 exits, not just 1, just in case the lender changes their criteria or something was to happen or change. So we're doubly sure that you can get out of this bridge. That's another reason not to fear it. You just have to factor in the cost of the bridge as a cost of your refurb project, for example. And you know, you can make use of the opportunities that are there, because, you know, the market, when it changes, it does bring opportunity, and, you know, it can be very unfortunate for some, and it can be very fortunate for others. So there's always 2 sides of a turbulent market or a recession, or you know, and history has a funny way of repeating itself. So we've seen all of this before. We know the market will grow, we know it will dip. And so yeah, as long as your strategy is right and you're doing your calculations, which obviously we can help you with and guide you, then you know, there's opportunity out there for you to make some money. So hopefully this has been helpful. I appreciate there is quite a lot that I've sort of babbled through in quite a short space of time. If you've got any questions or you feel that I didn't cover something, which is very possible, let me know. I'm happy to answer them, give you a phone call, do another video even, just to go over some things that maybe I haven't said or I haven't made clear, but hopefully that's given you a really good understanding. If you've liked this video, then let me know. Always welcome feedback. My mission is just to give you information and tips. This is not advice. But also, you know, obviously very happy to give you advice, and also any brokers out there that are doing mortgages and insurance and are sort of dabbling with wanting to get into commercial, or have a few clients that are asking about bridging but you don't know where to go, give me a call. I'm more than happy to work with you. I have a lot of joint venture partners that I work with, a lot of introducers, and I'm more than happy to speak to them for you or to meet them with you, and yeah, we can go from there. So yeah, hope you all have a great day, last day of January, make it count, and hopefully this will help towards your future plans, and I hope to see you again soon. Bye.